Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field.
Rob, Hanna, welcome to the show. It's good to finally get you on the Algorithmic Advantage.
Thanks, Simon. I'm looking forward to it. I'm excited to be able to talk with you this week.
Awesome. Rob, how long have you been trading? Because it's been a while, right? And how much of that has been discretionary versus systematic?
So I started as a discretionary trader in the mid-90s, and I started doing two types of trading, really. I followed O'Neill type stuff.
Yeah.
So breakouts and, the can-slim methodology and all that. And I did that for a little while. At the same time, I was trying to learn day trading. So I did both of those things, and it evolved pretty quickly over the years. I found my niche it's continued to evolve. But in 2001, I started trading full-time for myself.
Mm-hmm.
And then in 2004, I got more into quantitative analysis. So what I found that year is that was a year where there was a lot of rotation in the market. So I was doing O'Neill stuff, like I mentioned, and we'd get a breakout in financials or energy or something, and I'd go buy in the breakout, and then it would rotate into tech or whatever else.
Mm-hmm.
And I got beat up that year. It wasn't a terrible year for the market, but I was basically flat. I think I made like 1% or something. So I started doing some research on my own and really digging into the numbers of what happened with some of my ideas, and started learning myself about market action. I used TradeStation for a lot of my research back then, and also just Excel. I printed out giant spreadsheets. I had them all over my wall. It looked like a beautiful mined wall at one point. I started doing research, and I started to unlearn some of the things that I had learned which were wrong. And from there, I got addicted to the research, really. And it helped me as a trader to stick with what I knew had an edge. So, for instance, if the market's, whether it's running higher or selling off, if I'm in a position, there's always, is it time to sell? Should I still be hanging on to this because it's going against me too much, or going so much in my favor that I'm afraid it's going to top out? So what my research was initially intended for was to give me an idea of whether I'm, the positions I'm taking still have an edge. It took the edge off my anxiety is what it did. So, if you know you got an edge, you can stick with it. And if you know you don't, then it's a reasonable time to get out.
So at this point, you were using the quantitative analysis to assist in your discretionary trading, could you say?
Yes. Yeah, exactly.
And that's
so
evolved.
I hadn't designed much in the way of systems yet, but it was just a matter of, hey, let's look at some numbers and what's the market typically do after this has happened. And I would just describe what happened today or yesterday or last week or month or whatever, and try and figure out where it has historically gone from there.
And that's evolved because presumably now you're 100% systematic and fully automated, or where do you sit with it now?
Mostly automated, and 90% systematic.
Yeah, okay. What's the 10%?
I've got some models that I use some discretion with, but I'm able to measure my indicators in them. So I may or may not take a trade as heavily as the indicators would say. So for instance, I trade some VIX-based strategies, right? And some of them look to take advantage of short volatility edge, right? So over time, what you see if you look at a standard VIX ETF, for instance, is it has a tendency to go down. The VIX futures do too. They have a tendency to go down just because volatility is normally slightly overpriced. and there's other reasons in there with the futures term structure, but I have some indicators that let me know whether I want to go short vol or long vol. And for the most part, I will follow those indicators, but I will use discretion in the size that I take, knowing what I know about what's upcoming. So do we have some big announcement tomorrow? Do we have something on the horizon in the next week that's going to affect volatility or the volatility term structure? And just having a deeper understanding of what's going on rather than saying, all right, well, these indicators were overbought or were sold, and we've got Contango or backwardation, and I'm going to base my trade entirely on that. It's a little bit more nuanced than that.
So you started with this research-based framework, I guess, Rob. Does that define you, do you think, as a trader? Like, what are the kind of, attributes you'd apply to yourself? Like, what's your philosophy in trading? Is that one of the key things that, everything's just sort of research-based and built up from some research that you've done rather than, sort of more of a machine learning approach, for example? Like, how would you sort of big picture define yourself as a systematic trader?
Yeah, I basically want to know I have an edge, or I want to be real, strongly confident that I have an edge if I'm going to take a position. So, and a lot of what I do is fairly short-term trading. I'm not holding on to positions for years. I'm generally holding on for days or weeks or sometimes months, depending on the model. But as far as defining myself as a trader, it's all based on research. Yeah. So I don't trade anything that I don't know what my edge is anymore. When I first started trading, I followed a bunch of signals that I read out of some books. And one of the things I did is I would measure how each of these signals did over time. So it was day and swing trading signals, basically. And then I also had another category that I called my hunches, right? So I had all these different setups, and then I had my hunch set up. And after about 6 months of tracking my P&L, I learned pretty quickly that the hunch setup wasn't so good.
Yeah. Been there, done that.
So, that was how I learned how to not just trade hunches or rumors or anything like that. That tend to lag, or, if I was lucky, break even. It was basically like sports betting, right? You think but you don't know enough to cover all the commissions and expenses, and you gotta have a plan to get in, you gotta have a plan to get out, and the hunches didn't always have a plan to get out either.
So, Rob, let's just start with your current sort of business operation. Like, what are you involved in at the moment? What are you doing these days?
So I essentially have two jobs, I guess you'd say, right? I've had quantifiable hedges for a long time, and that's my baby, where I publish a lot of my research. Quantifiable hedges is effectively a nightly newsletter. And then I've got some courses up on the Quantifiable Hedges site as well. And then in 2019, I began working with Capital Advisors 360, and they are a registered investment advisory. Prior to that, I'd run a small hedge fund, but I shut that down and joined Capital Advisors 360. And so I run my models for clients through them with separately managed accounts. So a lot of my clients are traders that know me from Quantifiable Hedges. They might have followed my work for several years, and they might trade differently than I do, but they'll give me a part of their book of portfolio and say, you manage this 15% or 20% or whatever it is, and it'll be uncorrelated to the things they're doing. So I might be the aggressive portion of someone's portfolio, trading, 2x SPY in and out, or I might be trading VIX for them, or it might be the conservative portion of portfolio where I'm trading, treasury bonds and some overlay strategies.
Yeah, right. Okay, so obviously I'd want to ask you about your strategies. That's what this show's all about. But before I do, you mentioned TradeStation. So what's your tech stack look like these days? Are you still a big TradeStation user?
TradeStation's real good for if you want to do a quick, study on
one asset
market, right? So if I want to say, what's the S&P done after a 3-day pullback above the 50-day moving average, something simple like that. You can run a quick study, and it's like, you can do that in 5 lines of code. So very easy. It's not good if you're building a model portfolio, for instance, or a rotational portfolio, or something like that, where you really want to dig in deeper and you want to track. I've got some models that will trade stocks, and I want to make sure that they were in the S&P 500 or in the S&P 100 that day. TradeStation's not able to do that. For that, I use tools like AmiBroker and RealTest. I use both of them. I got turned on to AmiBroker years ago, and I just started using RealTest in the last few years. I like that a lot as well. And then for a data provider, for both of them, I use Norgate data. With Norgate, it makes it real easy to avoid that survivorship bias. If you're testing out S&P 500 or S&P 100 or 1500 or NASDAQ 100 or whatever it is, you can just put in a line of code that says, if the setup occurs and this stock was in the index on that day, then take the trade. Otherwise, don't. And it's just that little end. If the stock was in that index on this particular day, makes a huge difference.
Makes all the difference.
So you don't have the survivorship bias there. I'm sure you know that.
Yeah, no, that's great, and similar setup to myself. So if viewers want to learn more about RealTest and Norgate and the like, you can jump on our website, because I've got a bit of a write-up and some links on there.
I remember you did a RealTest and Python podcast. Was it a year or so
we did.
Ago,
we had
maybe?
Marsden from RealTest and Marsden Parker and Jason Strimple from PyQuant News. And, we talked about just backtesting frameworks and stuff. We're going to do a bit more of that in future too, because I'll be working with Tom Stark, and he does a lot in Python. And, I just spent a couple of days with him actually. And, what he does and how he does it, I think is world class. So people can actually they can start pretty simple in Python, and they can do some really powerful stuff and very fast as well if you do it right. So looking forward to learning a bit more from him. And it's good to have, I guess, that up your sleeve to be able to do some custom programming where you're, not constrained at all by the application.
Yeah.
So that's going to be interesting. I guess, Rob, okay, so your current portfolio, so what are you trading? Are you mainly stocks and ETFs?
Yeah, so I run a neighborhood of like 15 models, and then I have a couple of what I call composite models, which basically take a grouping of those 15 and put them together in kind of a model portfolio. And I trade ETFs, I trade large cap stocks, so S&P 500 stocks. I trade VIX securities, and so that would be mostly options and VIX-based ETFs. And then for myself, I also trade VIX futures.
Mm-hmm.
But for clients, I only do the options and ETFs because we're a registered investment advisor, so we can't trade futures.
Yeah,
because we're not a CTF.
Okay. All right. So like 15 core strategies, like what types of strategies are these? Are they kind of clustered around a certain type? Are they a spread of very divergent types so that they are diversified? And I want to ask next maybe about this VIX strategy and hedging or capabilities for for profiting out of market chaos, if that's part of the point there. But yeah, what's the sort of spread of your strategies look like? What are you trying to achieve in those different models?
Well, for one, whenever I add a new strategy, the goal is to have it come from a separate idea, right? And have it uncorrelated to other strategies that I'm trading. So we've got a few mean reversion strategies in there. That some of them trade individual stocks, Some of them trade a list of ETFs. So, for instance, I got one that trades a list of, I think it's 46 ETFs, and that's spread across market cap, sectors, and countries. So it could trade the S&P, or it could trade Italy or Spain or some other country, or it could trade the XLK, the tech ETF or something like that. I don't compile the list basically on their liquidity and the fact that I'm looking to avoid doubles in there. So it'll trade SPY, but it won't trade IVV or VOO because they're basically the same thing.
There are ETFs out there that are essentially trading the exact same underlying, so you don't want to have both of them in your portfolio at once. Yep.
So those are some of the mean reversion strategies. I also have strategies that are momentum based. I have a long-term, or I guess you call it intermediate to long-term strategy that rotates between bonds and stocks based on the leading index at the time. So it'll go S&P, or it'll go NASDAQ, or it'll go into some bonds.
Would you call that a sort of a tactical asset allocation style model?
Yeah. It's not it's kind of a narrow tactical one. I mean, some tacticals are like rotation into many different sectors. This, we're looking at 3 or 4 different possibilities of where we're going to go.
That's all with ETFs, that one, I take it?
A version of that in what I call my market dynamics course on quantifiable edges. I released that in like 2014, seasonality cycles, and also price indicators.
Yeah, okay.
So it's a few simple indicators, and what I call my momentum and seasonality model that I trade for clients is similar to what you would find in that course. So I released that in 2014. I did an update in 2023, and that's something that's on the website if people are more interested in like checking out the ideas there. In addition to that, I have VIX-based strategies. I've got a few that trade short volatility, and then I've got one that tends to have long volatility exposure or be neutral. It's not looking to short volatility, and that's to take advantage of times like we're getting into. The VIX is up at 26.5 right now, so it's not exactly a total panic situation, but we've got some increased volatility here, and the futures are starting to flatten out. And when we get funky moves in the VIX futures, then that strategy will look to take advantage of what I would refer to as mispricings there.
So for reference, we've just finished trading the day of the 20th of November in the US, 2025.
Yep.
So, it's been a pretty wild month. Been a pretty wild month in my portfolio too. The markets have been, the equities markets have been up and down all over the place. Okay, let's go back to the mean reversion quickly. So on the stocks, that's S&P 500 stocks, is it?
Yeah.
That you would trade mean reversion on, stay on those high market cap, high liquid institutional names?
Exactly. So it's got to be like S&P 500, S&P 100, NASDAQ 100. I don't trade small caps with mean reversion. I tried it years and years ago, and I just didn't find it to be as reliable. If you've got, I think institutional ownership is the biggest supporter of mean reversion when you're talking about individual stocks, right? So if you've got many institutions that are owning a stock, someone is going to be looking to buy in at bargain levels if it sells off kind of hard. If you're dealing with small caps that might only have 1 or 2 institutions that own it, and that one institution, one of them wants to get out, it's just going to go down and down and down and down and down sometimes. So you also might have a real problem stock that's getting closer and closer to bankruptcy or something going on there. That's much less likely in the S&P 500.
Are you trading long, short, both long models and short models?
Yeah. Yeah. And I don't trade them exactly the same. And I use trend filters for some of that. But yeah, I'll trade long and short in S&P 500 stocks.
What's some of the research, just thinking about the way you do research, what's some of the research that backs up your mean reversion models? And talk to me about how you manage risk, that negative skew in mean reversion, whereby the thing that everyone's worried about when trading mean reversion is that you can do quite well for a certain amount of time and then drop off a cliff when everything goes bad at once. So how do you manage that kind of risk?
Yeah, well, it is an issue, right? If you're trading, say, a real simple strategy that is like, all right, I'm going to buy every 5-day low and sell when the market crosses above its 5-day moving average, right? So that's a simple mean reversion type idea. And if you ran that back, you might see that you make money on 75% of the trades, and it'll have a nice steady up, drop. Up, drop, right? And the drops can be harder. For one, I manage via position sizing. And for two, I manage basically with confirmation from other sources. So for the S&P 500, for the individual stocks, I generally won't be trading them unless I have my short-term market indicators also on my side. Right, so I don't want to be buying a pullback in an S&P 500 stock if the market has been rocketing higher and I'm expecting a pullback. If the market's breaking down sometimes and it looks like it's going to go lower, again, don't want to be getting long. If we're coming out of a real oversold condition and we've been selling off and we're coming off of 6-month or 12-month lows or something like that, and you get some real strong thrust days upwards, that's generally not a great time to try and short a bunch of individual stocks, right? Because now they've got short covering going on plus bargain hunters, and they can really power higher. So I use a tool for myself I call the aggregator. You can look it up on the website. I've written about it some, but I feature it in my newsletter every night. And it basically just takes all my individual studies of the market and it computes, what my expectations are over the next few days. And if my expectations are positive and the market's not already overbought, then I have a bullish bias for the next few days. And in that case, I'd be looking to purchase purchase stocks. If the aggregator is bearish, that's when I'd be looking to short stocks. And if the aggregator is neutral, normally I'm sitting out any new entries and just waiting for a bullish or bearish signal.
Yeah, all right. Well, I'm looking forward to deep diving a little bit the aggregator in our sort of members content at the end of the show, because that is quite interesting. So when you say the impact of the aggregator on your long shorts, does that mean that if you've got a bullish short-term outlook, your short strategies go to sleep? Do they? And then the contra is also true. If it's a bearish outlook, your long models will go to sleep. Does that mean that the existing open positions get closed, or just doesn't take any new open positions?
They don't necessarily get closed, but it won't be taking any new positions, right? And the idea behind it is, it's kind of the rising tide lifts all boats, right? So if you got the market on your side, you got a better chance of success than if you're trying to swim against the current, right? If the market's not on your side, you got to be a really good stock picker. But if the market's on your side, you don't have to be that smart.
Yeah, does that short, because it's a short-term outlook, does that mean it can kind of wobble around fairly quickly over the course of a week or a month?
Yeah, it certainly can. Yeah. And so that's something that, it is possible that in my long-short S&P 100 mean reversion program, I might have some longs and some shorts active at the same time if I've, for instance, taken some longs and they haven't exited yet, and then I get some short signals. So they would kind of offset each other.
Rob, the way that I approach the mean reversion on the stocks too is to really kind of diversify over the mean reversion strategies, or, the setups and the entries and the exits. And the other thing that I do is, I'm careful about how much exposure I can put on on any given day. So I really throttle my exposure so that I spread it out a little bit over time. Do you do anything like that? Do you do anything where you have multiple different multiple ways of measuring that reversion, and therefore maybe different models picking up different kinds of reversion? Or is it fairly simple that you've aggregated that into one kind of netted strategy, as it were?
No, I mean, some of my models will use the aggregator, but and some of my models will go all in immediately, but I've got others that scale in, right? So I've got a model I call my catapult model, and I've written about that since the newsletter started in 2008, and that'll take on trades in stocks that are selling off very hard, right? So it's truly a mean reversion. It's looking for capitulation, and it's looking for a reversal, and some people would call it like a catch falling knife type strategy, which is why I find scaling into those trades tends to help.
Yeah, so you've actually got a bunch of different mean reversion models looking at slightly different things, running at different times, and therefore,
Yep.
I guess, massaging that exposure out. And that's a bit of a risk management tool in itself, correct?
Yeah, and they don't overlap each other either. So, for instance, I mentioned, S&P 500. Really, I got a couple of models that I trade for clients. I call, one's my Swing 100. That's the S&P 100 stocks, and another one's the Swing 400, and that's the S&P 500 stocks that are not in the S&P 100, right? So it's the next 400. So I wouldn't get a signal with both systems in the same stock, and so that's something I make sure of. I also, with some systems, I cap out the amount of exposure to any particular sector. So, for instance, my Swing 400, I won't go more than 30% long in any one sector, right? So if financials are selling off hard, we might take a 30% position in financials for a mean reversion trade, but I'm not going to fill up every portfolio slot and go 100% long financials. So that we'll be looking at healthcare and consumer discretionary and whatever else
is that something, Rob, that does actually backtest out better, or say logical rule that you overlay for risk management purposes despite the backtest? If you know what I'm asking, like
I know what you're asking. I'm trying to recall the backtest. It's been years.
Yeah, right.
But as I recall, it made it smoother. It didn't necessarily improve the compound annual growth on the portfolio, but you had a smoother upline than you would if you're like, all right, just whatever's triggering, I want to take, right? Less volatility.
Okay, I'm interested in mean reversion on ETFs as well. So you've got this basket of ETFs. Do you trade them in a similar way to stocks where, you could be trading multiple positions at once and you sort of treating them like a small, basket of stocks? Or is it more that it's selecting one individual ETF at a time to have a position in? How does that work?
No, I got multiple ETF mean reversion strategies, but the one I was referring to earlier does, it's got a big basket of ETFs. It'll pick up to 4 of them at one time and go long or short, right? So it's basically a 25% position in whatever's triggering, and that could be 4 long trades, it could be 4 short trades, it could be somewhere in between. And it's with the mean reversion model, it can also be flat, right? So it's not always in something. It's not like a tactical asset allocation. It's just looking to take advantage of opportunities when they arise.
And presumably stocks on average can be more volatile. I mean, I know you're talking about the S&P 500, but slightly more volatile than the ETFs. So perhaps the amount of reversion or stretch that you'd be looking for in an ETF, does that tend to be a bit less than when you're dealing with individual stocks?
Yeah, it's not greatly different. I mean, on a percent basis, yes, right? You might not need as big of a percent pullback, but on a relative basis, if you're using some overbought, oversold type indicators, you don't need to use greatly different parameters for a list of ETFs than you might for a list of stocks, at least from what I've found.
So you were able to take your stock mean reversion models, more or less, and start applying them to ETFs, massage a few things, but using a lot of the similar principles and indicators?
Yeah, for that ETF swing model, it's quite similar to one or two of my stock models.
Yeah, right. Awesome. Do you do any sort of trend following, or so you mentioned that sort of the bond and S&P 500 model, but do you do any sort of trend following on ETFs?
Not beyond NASDAQ S&P. So I don't have right now a model that I like that will jump in and ride a breakout higher for weeks or months or what have you. That is something I've been meaning to go back and look at it. I've looked at it a few times over the years, and I never really loved what I found. So I tend to have more of a mean reversion personality, and I'm fine with slow accumulation in my trend following. So that's why I'm okay with trading, S&P or NASDAQ type ETFs or futures or whatever there, rather than looking for individual breakouts in stocks. So I've never caught the NVIDIA run or the Tesla run, or the stock of the year is not something I've held all year.
All right. Well, I want to ask you a bit about risk management and then maybe deep dive that VIX work you do a little more.
Okay.
So, just thinking about risk, let me ask this. Are some of your strategies designed specifically as hedges, as strategies that can make you money when the others are losing money, or are they designed to profit in severe sell-offs, that kind of thing?
Yeah. So I have some models, if you're looking at like the individual stock models, that look to take advantage of strong sell-offs and tend to complement each other fairly well. So I have one that I call my Icarus short model. And what that does is shorts real high flyers that are very stretched. And I got another one, that the Catapult that I mentioned, that when there's extreme selling in the stock and in the market, then that'll start getting pretty long. So those will find opportunity where I might not be finding it other times. But the model that really looks to take advantage of high volatility, strong sell-offs is one I call my volatility ladders strategy. And that trades in VIX options. And what I do there is I basically look for opportunities within the VIX futures curve. And I will trade options there, spreads a lot of the time. It can be calendar spreads, diagonal spreads. Sometimes it'll just be put or call spreads for a certain month. But I'm looking for mispriced VIX options that I would expect would correct back to a more normal pricing in the weeks and months ahead. Some of these trades are more longer term in nature, but they take advantage of these strong sell-offs. And a lot of times I'll also end up with net long exposure in the VIX. So I may have a number of long calls that'll be sitting there that I keep if I've made profits in other areas. So in case there is a VIX spike, then we can take advantage of that, and it'll help other parts of the portfolio who are struggling.
What's the mispricing? When you say mispricing, what kind of things are you looking for?
So I'll give you an example. Last April, we had the strong sell-offs with the tariffs, right? the VIX spiked real strongly. In the previous August, we saw, I can't remember what it was. It was on August 6th. It was a Japanese.
Oh, yes, the sort of Japanese carry unwind.
Yeah, the carry trade unwind. That's what it was. So you get these massive spikes sometimes, and you'll find that you find backwardation in the futures, and you might find some real opportunities for taking on calendar spreads, diagonals, or something like that. So an example is I entered a VIX spread last spring that was looking at, June versus July 140 VIXs. Now the VIX has never closed at 140, but I was able to take some exposure there and get paid for that exposure and not have to, and it would only be at risk if we saw the VIX exceed 140 as we neared the June expiration.
Mm.
So that's kind of an extreme example, right? But I'm looking at little moves in the curve is basically what I'm trying to play. Another example might be when we were approaching the election in 2024, right? There was an inversion in the VIX curve where October was priced well above November, right? And I was expecting that to work itself out as we got closer and closer to the election. And the basic idea was that October, the election was ahead of that. It was still an unknown. The VIX was would likely be higher than it would be at the November VIX expiration because of the fact that there was no more election risk, right? So the curve was in backwardation for quite a long time there. But when you get to October, at that point when it's about to expire, well, now the election still hasn't happened. So if people are wanting to buy protection, and they might be buying VIX futures or options or S&P options, then they're going to have to pay out further. So they approached each other more closely at that point. So that's kind of the opportunities I'll look for is we'll have shifts in the spread or shifts in the curve, and I'll look to play those shifts. And sometimes it's one direction, sometimes another.
Yeah.
But overall, I'm looking I find the best opportunities when there is a big spike in the market. Then I can be able to put on a lot of positions all at once.
This is still something that you've been able to backtest, I presume. Are you just running backtests are you running backtests over the futures curve and testing this model, or are you doing other research and then kind of implementing this in a fairly discretionary way?
So I backtested these ideas back in 2021, 22. And what I did is I got all of the options data from the CBOE on VIX and created a database with all of their closing prices. And then we created securities that would represent spreads between 1 month, 2 months, 3 months, 4 months, or spreads in between the same month. And we made estimates of basically what price could you get on that spread, because you can't get the middle. If there's a 0 to 10 cent spread and you want to buy something, you're probably going to pay 7 or 8 cents for it. You're not going to get 5 cents. You're not going to get it for 5. So we had to put in all kinds of assumptions there and really designed it so that we built a database, and we build another database and test out all these ideas of, all right, well, what's the cheapest we could get this spread sometimes, and when would we most likely be able to get out of it the best? And it was a long process that it was, I used programmers and interns, and we had, it was a number of people working on it, not just me.
Yeah. So
that gave me kind of a baseline for some of the volatility ladders work that I do. And then, there's always additional research going on, like you said, with testing out the futures curve and testing out, VIX action and S&P action, and seeing where things most likely will go based on where they are now and what happened to previous times.
So just thinking about myself, if I wanted to implement something simple, I'd probably favor trading the VIX ETF. How important is this assessment of the futures curve in implementing a reliable VIX strategy? Is it absolutely integral to do that kind of analysis to get a good, or to get the kinds of VIX strategies that you've done, or could one do it without it?
You could do it without it, but you talk about mean reversion. It's the dangers there where it's up, big down, or something like that. It's the when you're playing with the VIX, you've got some real issues to potentially contend with as far as those ETFs move a lot. Now, for instance, if you look at what is it, UVIX is the 2x short one. I got data on UVIX back to like 2004. It was recreated data, right? It only came out a few years ago. But it would have opened at like a split adjusted $2 trillion or something, and now it's down to 10 or whatever, 12. So there's room to make money there, right? If you're shorting it. But what happens is if you short it, it can also go against you, 5, 10x at any point. So you can't be 100% sure.
In the past, we've had these Volmageddon events, that have wiped people out.
Or look at COVID, or really any big, strong sell-off. You can get wiped in these things. So it's very important to position size using these. And it's also very important to step out at times where there might be higher risk. And as far as building a short vol strategy, those are the two things I would say are the most important, right? There's a huge downside edge, but you got to be able to step out when risk increases. So that might be when the futures move from Contango, which is normally the case, right? Which basically means that the second month is above the front month future, to backwardation, where the second month is below the front month future. The basic idea there is that normally the futures curve will go upwards, right? From low to high.
Maybe we'll just quickly maybe we'll explain that even just one step more basic. I'm sure most of our viewers will get it, but just start from maybe just really quickly on the fact that there are these different expiries in futures that create that.
Right. So right now, the next futures expiry is December. Then you got January all the way out through, I think, July right now. And generally, January will typically be priced above December, February above January, and so forth. VIX it's measuring volatility. It's a measure of uncertainty, right? So however much uncertainty you have between now and December, you normally have more between now and January, right? So that's why the January VIX is normally higher than December. And as you go out each month, there's a little bit more uncertainty. So normally you've got a little bit higher futures price. What happens when there's an event where volatility comes in is there might be some kind of crisis that's happening right now. Okay. So it's one country invaded another, right? Or there's a bank blow up or something like that where, all right, everybody knows there's a lot of risk right now and the market's really moving up and down quickly. But when that happens, it's expected that the market will probably be more normal than this
in future
4 or 5 months from now. It'll return to normal action a month, 2 months, 3 months. So then the curve kind of inverts, right? So now we're saying, well, things are real risky now. They'll probably not be as bad down the road. And that's when you get into these situations where VIX futures prices are higher in the closer end months than they are in the back end months.
And so what's the basics of, stepping out before, potential chaos? Is that something where you're trying to read from that curve?
Yeah. So the VIX ETFs most of them try and maintain like a 30-day average hold period. So to do that, they need to roll their portfolio 1/30th effectively, or each day. And so when there's contango in the curve, which is normal, there tends to be a tendency for these ETFs to come down lower and lower, right? And when there's backwardation in the curve, a VIX ETF will go higher during the day. That overpriced volatility kind of wind behind it when there's backwardation in the curve. So one way is you could say, hey, is the second month higher than the first month? If so, we're in contango, and that might be an environment that I could look to take advantage of with my short VIX strategy. I'll step out when it goes from contango to backwardation. You could also look at different levels of the VIX, right? If the VIX spikes above 25 or 30 or whatever it is, maybe I'll want to step out at that point. You could also look at the VIX versus realized volatility. So what has volatility been over the last month, say 21 trading days, versus what is the VIX? Because that's expectations over the next month. And normally expectations over the next month are a little bit higher than versus what's happened over the last month. So we know the last month things have been fairly normal. We got to price in what if something happens over the next month if I'm going to be, for implied volatility within options. These are all things you can look at to say, all right, if the VIX spikes for whatever reason, now I might want to get out of my short vol type strategy or dial it back.
So to be clear, you do a lot of options trading where you are you're buying calendar spreads or some kind of spreads so that you are limiting your risk, right? Would you say that based on this kind of analysis and using these kind of risk management techniques that you're saying, one can also trade the VIX, say the VXX, outright? They just have to do it properly.
Yeah, exactly. And, one of the ways that I've found beyond these, looking at contango or implied versus realized volatility is looking at overbought, oversold of the S&P 500. If you go onto the Quantifiable Hedge's website, right on the front page, I think there's a link to a paper I wrote a couple of years ago. It's called Chicken and Egg, and it looks at timing the VIX using the S&P.
Right.
Most people try and do the opposite. They'll try and time the S&P using the VIX, but this says, all right, based on S&P action, how can we time the VIX? And there's some sample strategies in there that you could use to take advantage of it. But basically, if the S&P is strongly overbought, you don't have much of an edge trying to short the VIX because it's going to go from overbought to oversold, right?
Mm.
And if the S&P is strongly oversold on, say, a short-term basis, there's a decent chance it's going to bounce. Maybe it is a good time to short the VIX. So, you got some simple ideas like that. It's a good way to time the VIX, take advantage of the short volatility edge. And you can also take some long volatility exposure when the market is, say, strongly overbought and you want to protect against pullback in your stocks.
Your VIX course, Rob, on quantifiable edges, does that cover most of this? Is that what that's about?
Yeah. So it covers a lot of these concepts, and then it goes into a bit more detail on the stats behind it, right? So I generate spreadsheets, and there's some models in there, Excel type models, where you can go and say, I want to put in different parameters for all these different indicators that we're using. So I'll look at stuff like a short-term RSI of the S&P, and how is the VIX futures done, or how is the VIX ETFs done when the S&P has been, the RSI of the S&P has been above or below certain numbers.
Yeah.
And so it gets into all that, and you can build out models with the tools in there.
And just another question on just back testing. Say one was back testing the ETFs like the VXX. Now that those VIX ETFs have gone through changes over the years, I believe.
Yeah.
You know, the ones that exist today aren't the ones that existed in the past. Like, is there a simple way to create some, you know, a decent data set to backtest a hypothetical, you know, VIX ETF on? Does one need to do that?
Yes. So two things you can do. There's a site called Six Figure Investing.
Yeah.
Vance Harwood has data there. I think some of it's free, some of it you might have to pay for, where you can download a number of those ETFs way back, right? So it would be the equivalent of UVIX back to 2004, 2006, where he's basically regenerated it. The other thing you can do is the longest running one is VXX, but it switched 2019 or so.
Yeah.
So it first came out in like 2009, and it was basically set to expire in 2019, and they flipped to another one they call VXXB, or I'm not sure how they show them now in Norgate data, but you can basically test on the current one back to about 2019. You want to go back further than that, you test on the previous one. You can string those tests together.
Okay, cool. Yeah. Do you know what they're called in Norgate? Is it like that, VXXB or VXXA and B?
Give me a second.
Yeah, have a look. We can edit the space out.
So VXX is the current one.
Mm-hmm.
And that goes back January of 2018. It looks like right before the big blow up. And then the previous one is VXX hyphen 2019 2019
Yes.
01.
Okay. Yeah,
So
yeah.
201901, and that the lifetime of that is from February 2009 until February 2019, or the end of January 2019, around there.
Okay.
So it's it had a 10-year lifespan, and it was replaced by the new VXX.
I'm just mindful that we're going to run out of time soon, so I want to push through with a couple of things
Sure.
and end with a chat around your aggregator. So, like, okay, very interesting around the VIX. I want to investigate that further, do some work on that myself. So I'm looking forward to that. I think the other thing that I wanted to sync up on you was just this research-based approach that you have. Like, do you find that your philosophy, if you like, is one where you are, you know, building strategies in a robust way based on this research, and therefore it's not so much a matter of coming along after the fact and kind of doing robustness testing, you know, after the fact? Like, can you talk to me a bit about that philosophy? So, because I imagine it's a little bit similar to mine, like doing research, having an idea, maybe where you get these research ideas from, and then how you go about some of this research, and that, you know, is that kind of self-validating as you go then, so that by the time you build the model, you're not so worried about overfitting. I don't want to put words in your mouth, but that's sort of how I look at it anyway. But what's your philosophy around that research-based approach to building models?
Yeah, that's a good question. So, you know, I don't go in and try and build a model based on, you know, like rookie mistakes with building models are saying, all right, well, this say RSI2 is a good indicator, and I want to build an RSI2 system, and then I want to fine tune it so that it, you know, am I best buying when RSI2 hits 20 or 18 or 15, and then I want to get out when it hits 50 or 60 or 70 or whatever it is, and let's run a you know, an optimization and see what the best level is to get out at, and then what were the bad trades in there? Let's go see how I can get rid of them. Like that's that's a recipe for disaster, right?
Mm-hmm.
So when I when I build a model, is generally it comes from research and curiosity about the market. So like my mean reversion models, basically I said, well, let's look at the S&P, let's look at the NASDAQ. I want to understand how they performed over the years under different circumstances, right? So how has the S&P performed after it's made a 5-day high? What about after a 5-day low? What about after it's been up 3 days or down 3 days, or when certain indicators reach different levels, or when any mix of things happen? So you're just trying to understand how the market has performed under situations that are repeatable. And once you learn that, then creating a model that would kind of take advantage of whatever edge you find becomes a lot easier. And it's not a matter of fine tuning an indicator. It's more a matter of, okay, I know after there's been a big sell off in an uptrend that you got a decent chance to bounce. So let me define big sell off. Let me define uptrend, and let's play with it a few different ways, and I'll find a way to take advantage of it. And you're not looking for the ideal numbers. You're just looking for something that, hey, this looks, pretty consistent over time.
Yeah,
and it's an edge that you think will persist, right? So that's kind of the idea. And it's the same when I'm, any kind of model I'm looking at. Seasonality is another one. How have we done on certain days of the week? What about days of the month? What about around holidays? What about, on Fed days or employment days? And just learn about how the market's done, how consistent it's been over time. And then it's a matter of, all right, well, if I were to put this to work, what might it look like and how would it adapt over a long period of time?
Tell me a bit more about that Fed research. I think I've heard you talk about that in the past, Rob. So, what kind of data are you looking at from the Fed, and what's that telling you? What was the research you did there?
A lot of the research that I do with the Fed is just based around Fed day action, right? So there tends to be Fed days tend to be bullish overall, but they tend to be more bullish when there's some fear heading into the Fed day, right? And you can label, you can determine there's fear a number of ways, but if the market's sold off, right? So, hey, you close at a 5-day low, a 10-day low, a 3-day low ahead of a Fed day, or maybe you just close in like near the bottom of that day's range because people are selling out because they don't want to hold for the Fed announcement the next day. Then you tend to get a better bullish edge on Fed days. Whereas if the market has a run up into a Fed day, we close at a 20-day high, for instance, then there's not much of an edge on a Fed day. Some of my theory behind that is the Fed for years and years saw it as kind of their job to talk down market panics, right? Mm-hmm. Like the market's selling off hard and our stats look like, it's not as bad as you thought. And we're going to cut rates or whatever we're going to do, and it's going to be fine. And then they would also do the opposite, where it's like, the market's getting too strong. It's up to us to dial back economic activity. We're going to raise rates. We're going to do, whatever it is that the Fed needs to do to kind of quell the excitement. So that was a little bit of it there.
Any other research of late that has taken your attention? Any interesting research?
Yeah. Well, one more point on the Fed day.
Sorry.
Stuff.
Yeah.
One of the most interesting things I've found, that I've written about it a few times in the blog, is the Fed day edge typically plays out before 2 p.m. Mm-hmm. So if you say, all right, there's a bullish edge, 2 p.m. being when the Fed announcement is. If there's a bullish edge, we've got a strong sell-off going into a Fed day, whatever it is, most of the money has been made between, say, Tuesday's close, assuming the Fed day is on Wednesday, and Wednesday at 2 p.m. After the Fed announcement, it's chaos.
The insiders have already traded.
Yep. And it's It can go up, it can go down, but over the long run, it's basically been sideways, as opposed to leading up to the announcement. That's when the edge plays out. So that's interesting. People think the announcement is
what drives it.
Is what drives it, but it happens before the announcement.
Interesting.
So, you mentioned other interesting research.
Yeah.
I did one a couple of weeks ago that I looked at. I noted it's been like 200 months since the March 2009 bottom. And I looked at S&P and I looked at NASDAQ. And first I looked at the S&P, and I had data for that going back to 1928 or so. And I said, all right, over the last 200 months, how's the market performed? We know we've had a massive bull market. And then compare that to the rest of history for 200-month periods. So I did a rolling 200-month. And what I found was this was the second strongest 200-month period, right? So it's about 16 and 2/3 years.
When was the strongest?
I think the strongest was internet bubble.
Yeah.
So it ended in around 2000 or so. And after previous toppings out of that rolling 200-month, you saw severe underperformance over the next 200 months. Now I looked at this with the NASDAQ as well, and actually the last 16 and 2/3 years have been stronger than the internet bubble. So this has been the strongest 200 months through like October of this year that we've ever seen for the NASDAQ. And, you look at anything past that's approached it even, and the next 16 years haven't been nearly as good. And so my takeaway from something like that is that, if you've been buying and holding for the last 16 years, it's been the best 16 years to do it. Mm-hmm. But don't expect that to happen for the next 16.
Yeah, be prepared.
We may be in for some severe underperformance.
Have some hedging strategies in place.
Or at least some strategies that'll get you, in and out of the market as opposed to buy and hope, right? Whether it's a tactical asset allocation or just
shorter term.
Using a simple filter. Let's get out when there's a S&P falls below its 200-day moving average, or something really simple like that has worked well over the very long term. It wouldn't have worked well over the last 16 and a half years because those are the strongest 16 and a half years you've seen. But
and I think, Rob, you've been doing some work on breadth, and you've got a course coming out on new breadth indicators. Is that right?
Yeah. So the course is going to look at a lot of well-known standard breadth indicators like the Zweig thrusts and Walter Deemer's BAM signal. What's he call it? I'm losing the.
Not sure. And I think breadth. Okay. I think tick and trend and advanced decliners and things like that.
Yeah. We look at all that. Look at the McClellan oscillator. I look at, and then I look at my capitulative breadth index, which I've done at Quantifiable edges for a long time. I look at, I have a 770 breadth signal. That's another breadth thrust. The capitulative breadth index is interesting. That looks at basically one of the models that I feature in the newsletter all the time. It's my catapult system, and it's a basic count of how many triggers are active at any one time. And when it gets above a certain level, it's shown a real high propensity for the market to bounce. So it's measuring S&P 100 individual stocks. When you've got a lot of capitulation in individual stocks, there's a good chance that the market's also capitulating.
Yeah, so people could build their own breadth indicators, based on, these underlying
That's the idea.
flags.
So what I'm trying to do is put a bunch of it into real test and show people also how to build their own indicators similar to the ones I use, and also provide a lot of the ones I use in that code as well.
Yeah, cool.
I'm excited to
get
that out. I've been working on it a long time, so hopefully I can get it done soon.
Nice. Yeah, I wouldn't mind seeing it. So, all right. Well, look, I want to just ask you a bit more about the aggregator, and then I know I've got to let you go. But before I do that, for our members, can I just get you to tell us how people can follow you? Where's your website? You've actually got a bunch of followers on Twitter, so don't forget to mention that. And
So Quantifiable Edges, 2 words smushed together, is my website. And then Twitter it's at Quantifiable, and then there's not a second E, it's just DGS because I ran out of.
Yes. Quantifiable DGS.
I ran out of letters.
On Twitter.
Yes, Quantifiable
on
DGS.
X.
There it is.
Awesome.
Yep.
All right, Rob.
That's on X and Blue Sky, and I also do stock twits.
Okay. And you're on LinkedIn as well. People can look you up.
Yep. Yeah, you can find me there.
Cool. All right. It's been a real pleasure, Rob. Hang around.
Thanks so much for having me. I enjoyed getting to talk to you, Simon.
Yeah, awesome.